Every successful business evolves. And to keep up, you need a bank relationship that evolves too. When you collaborate with KeyBank, you don't get one-size-fits-all solutions. Our expansive team of experts across industry verticals wouldn't be here if you did. Always ready with bespoke solutions for your biggest challenges and opportunities. We know all businesses are different, and that's why we approach business differently. Reimagine business as usual. KeyBank opens doors. Learn more at key.com/B2B.
Welcome to the Age of Jeremy. This is Markets Radar with Jeremy Quintanilla, a show about markets, stocks, bonds, crypto, and everything in between. And I give you my take on what it all means. You might remember me from such businesses as 3T Warrior Academy, Blockheads, which created Merlin, the smartest way to track your crypto, Freedom Insurance, and many, many more. Right now, the global energy system is suffering from critical short refining capacity. According to reports from Moelis Research, nearly 10% of the entire world's capacity to refine crude oil is currently offline. That is roughly 5 million barrels of refining capacity a day that simply cannot reach the global market. Think about that. 1/10 of the world's fuel making capability has vanished, and the reasons are heavily geopolitical. First, we have the Strait of Hormuz, which is currently legally closed. Second, we are seeing continued Ukrainian military attacks targeting Russian oil refineries. And third, China has enacted a strict export ban on refined products. Because of these three massive disruptions, the remaining refineries left standing are forced to run completely flat out just to meet existing global demand. They are pushed to their absolute physical limits, meaning they are unable to produce fuel even if there's plenty of crude oil available for them to produce. This brings us to a stunning set of numbers that shows just how hard the major oil companies are running their machines. During the second quarter, ExxonMobil, which operates the single largest refinery network in the world outside of China, ran its Gulf Coast refineries at a staggering 95% utilization rate. Chevron's U.S. facilities ran even harder, operating at an unbelievably 90% capacity. And Shell PLC actually ran its refineries at a mind-boggling 102% utilization rate during the same period. Running refineries at 95% to over 100% capacity means that there is absolutely zero room for error. Any unexpected outage, pipeline leak, or weather disruption could instantly send shockwaves through the market, and we are approaching a dangerous turn. Shell has already warned that it expects its utilization rate to drop this quarter because it has to shut down parts of its network for scheduled non-negotiable maintenance. As Chevron's chief financial officer, Amir Boner, recently warned, the geopolitical certainty has tightened markets and is reinforcing the importance of reliable supply. Boner made a chilling point that investors need to hear. The natural shock absorbers that have historically mitigated extreme market volatility are actively being drawn down. And who benefits from this bottleneck? It is the refineries' owners. Because capacity is so tight, fuel-making margins on the U.S. Gulf Coast are hovering near all-time lows. It's a highly lucrative environment for big oil refinery segments, but a punishing reality for everyday consumers. So let's talk about the retail numbers because they highlight just how severed the connection between crude and refined products has become. In the United States, retail gasoline prices are sitting just 10% below their absolute peak of the year, which occurred back in May. But remember, West Texas Intermediate crude oil is down 6% from its high. The disconnect is even more brutal when you look at what Chevron CEO Mike Wirth calls the real pain point: middle distillates. The category includes diesel, jet fuel, and heating oil. Retail diesel prices are currently sitting a mere 6% below their highest level of the year, even though the drop in crude oil has been 4 times as much. According to Rob Thamil, a senior portfolio manager at Turquoise Capital Advisors, gasoline prices have completely decoupled from oil prices. Instead of tracking crude gasoline is now trading strictly based on storage levels, otherwise known as inventories. So essentially, it usually trades based off of the crude price. Now it's trading based off of the inventories of the oil that companies have. And right now, refined product inventories are rapidly approaching historical lows, which means that those prices will probably drive back up. This pricing disconnect is causing severe political friction because dickhead Donald Trump has heavily criticized big oil in recent weeks, publicly blasting the major oil corporations for failing to bring retail fuel costs down fast enough for struggling drivers. But as the data shows, the oil companies are physically unable to refine more fuel to bring those prices down because of the war that he is causing. Now, if you think the current price at the pump is bad, which I admit I've seen it when we were traveling to California a couple weeks ago. I saw it was $6. I was like, oh, that seems kind of high. I don't pay much attention to that because it for some reason I don't drive a lot and it doesn't really affect me all that much. But I can see how someone who has to drive every single day, or if you're if you're a salary man or a businessman or businesswoman and you have a drive, that cuts so high into the expenses that you have for the year without even getting a raise or anything of that nature. So again, people can be hurt hard when the price of the gasoline goes up. So we're entering the third quarter, and Chevron CEO Mike Wirth is already warning that we are going to continue to see upward pressure on product pricing through Q3 and potentially well beyond that. Why? Because the market is highly likely to tighten even further as countries in the Northern Hemisphere begin to restock their heating oil inventories ahead of the cold winter months. Because again, oil is not just for gasoline. When winter restocking begins, it competes directly with diesel and jet fuel production, squeezing the middle distillate market to its absolute limit. Even ExxonMobil CEO Darren Woods, one of the most experienced executives in the entire energy sector, admitted on a call with analysts that he has never seen available refining capacity relative to a demand as low as it is today. His conclusion was stark. Here's a quote. He says, "It's going to take a while for the industry to climb its way out of this hole." And again, we're not even really at the end of the situation. So we're not at the point where we can start to begin to climb. If fuel making margins are near record highs and refining is the absolute bottleneck of the petroleum system, why can't major oil companies simply build more refineries to capture these massive profits, ease the bottleneck, and bring down inflation? The answer exposes a hard structural reality that the market has to accept. You cannot build your way out of this crisis very quickly. Again, to what I was just saying before, and high fuel prices are structurally sticky. First, expanding global refinery capacity is a massive multi-year capital-intensive endeavor. It takes years to plan, permit, and construct refining infrastructure. ExxonMobil CEO Darren Woods explicitly warned that it will take a significant amount of time for the industry to climb out of that specific hole, like I had just mentioned. Second, the current shortage isn't just about a lack of physical plans. It is actively driven by active geopolitical conflicts. When 10% of global refining capacity is physically knocked offline due to the closure of the Strait of Hormuz, ongoing Ukrainian strikes on Russian facilities, and the China's export restrictions, the capacity cannot be simply replaced by any type of domestic expansion. This means that traditional market shock absorbers, excess inventories, and idle capacity are gone. For investors and consumers, the takeaway is as long as geopolitical conflicts keep 5 million barrels a day off the market, fuel prices will remain disconnected from crude oil, serving as a permanent, stubborn driver of inflation that interest rate hikes cannot easily solve. So the bottom line is that the bottleneck in the energy sector has officially shifted from the oil well to the refinery. As we march into the third quarter, expect continued upward pressure on gasoline, diesel, and heating oil. We'll be right back.
Trading at Schwab is now powered by Ameritrade. bringing you an expanding library of education with even more ways to sharpen your trading skills. Access new online courses, insightful webcasts, articles, engaging videos, and more, all curated just for traders. Plus, guided learning paths with content designed to fit your unique interests. No sifting to find exactly what you need, so you can spend your time learning to trade brilliantly. Learn more at schwab.com/trading.
Your team just added its 67th AI tool, and also your 67th security blind spot. The good news? The Vanta agent works like a GRC engineer in the background, finding every app your team uses, scoring the risk, and drafting fixes for you. Vanta is the platform used by over 16,000 fast-moving companies like Ramp, Cursor, and Harvey, who are shaping the future with AI and staying ahead of AI risk. Get started at Vanta.com.
Let's go over to the high-stakes world of digital asset and speculative tech. Now, again, I buy and sell cryptocurrency. I love cryptocurrency. I love digital assets. I love how the world is moving more towards cyberpunk reality. That is just something that I enjoy. So make sure on Mercury yesterday, we did a preview of Apple's Neuromancer, which will be coming out in January. And that will be when I actually get an Apple TV subscription because I want to see Neuromancer. But apart from that, let's talk about cryptocurrency. The headline story of yesterday and today is Bitcoin, which is put on a volatile display of fading risk appetite. The original cryptocurrency has officially broken key support, sinking below the $63,000 mark on Friday. In fact, we saw Bitcoin slump by as much as 3.6% to hit $62,403, just right above my $62,000 entry target, where I would buy more Bitcoin. And if you want to learn about all of that, head on over to the Coach JV channel at CoachJV_, or check out the Merlin channel on Instagram at Merlin_crypto or at Merlin Crypto. One of those two will get you over there. If you step back and look at the broader picture, this isn't just a minor bump in the road. Bitcoin is now down roughly 30% for the year, and most smaller, less liquid tokens are sliding right along with it. So what is triggering the sudden rush to the exits? Is this a healthy consolidation, or are speculative investors permanently pulling back from the market's riskiest corners? Let's go ahead and talk about that. Let's start with the regulatory landscape, because for months, the crypto industry has been banking on a major catalyst in Washington. They've been waiting for a savior. They are waiting for the Clarity Act. Investors had hoped this bill would provide much needed regulatory clarity and pave the way for wider institutional adoption. But those hopes have officially hit major roadblocks. The Clarity Act is currently struggling to advance in the Senate, and the clock is ticking loudly. Tick tock, tick tock. I just added that sound effect. That was just me. It wasn't a real clock. Lawmakers are preparing to leave Washington for their August summer recess, with next week marking the critical deadline. The loss of legislative momentum has completely removed a major bullish catalyst from a crypto market that was already struggling with weaker overall trading activity. Joshua Lim, the global co-head of markets at Falcon X, summarized the frustration beautifully. He noted that crypto has had a hard time maintaining a bid. I don't know how beautiful that statement is, but apparently the people at Wall Street Journal did. According to Lim, investment funds are this could be from Bloomberg's, actively selling it. Anyway, according to Lim, investment funds are actively selling into any temporary market rally as their expectations around the passage of the Clarity Act begin to diminish. To make matters more frustrating for day traders, the implied volatility on Bitcoin is currently hovering near historic lows. This is because a large supply of overriding funds is keeping the asset strictly range-bound, preventing any meaningful breakout on the upside. While Washington stalls, the corporate arena is delivering its own share of bad news. Two major corporate bellwethers for the crypto economy, Coinbase Global Inc. and Strategy Inc. just reported disappointing quarterly earnings that have sent shockwaves through the market. Let's start with Coinbase. The exchange's quarterly results underscored a soft and fading demand among retail investors. who seem increasingly reluctant to chase the crypto market. Wall Street reacted swiftly and brutally to the news. Shares of Coinbase tumbled a massive 11% to close at $146.26. That represents Coinbase's absolute biggest one-day percentage decline since February 5th, and that's why I have been buying a short against it called Fiat by YieldMax, which looks to be paying off. Meanwhile, Strategy Inc., which is currently the largest corporate holder of Bitcoin, reported a staggering quarterly loss of $8.22 billion. The reason for this massive multi-billion-dollar hit, the ongoing decline of cryptocurrency directly eroded the value of Strategy's massive balance sheet holding. Following the report, shares of Strategy Inc. edged 4.6% lower to finish at $93.28. When the largest corporate holders of Bitcoin is taking an $8 billion hit and the premier retail trading platform is warning of softer demand, it is a clear signal that the speculative momentum might be drying up. But we can't look at crypto in a vacuum. Bitcoin's sudden retreat is landing against a highly fragile backdrop for all speculative assets, including mainstream equities. On Friday, yesterday, stocks were back on the defensive after experiencing wild swings in some of Wall Street's most crowded artificial intelligence trades, as we have mentioned earlier. This suggests that day traders who previously chased the market's highest flying, riskiest corners are suddenly becoming much more reluctant to put their capital to work. Compounding these equity jitters is the macroeconomic picture. Following the latest Federal Reserve meeting, long-term interest rates have continued to spike post-Fed, putting immediate downward pressure on risky assets. Tang, the managing partner of Monarch Asset Management, put all these pieces together perfectly. He explained that between Coinbase's disappointing earnings, the Clarity Act's long losing steam ahead of next week's August recess, and long rates continuing to spike post-Fed, markets across the entire board are heading into a defensive, risk-off posture. When safe long-term treasury yields spike, the incentive to hold speculative, highly volatile assets like Bitcoin drops dramatically. If Bitcoin is down roughly percent this year, and major catalysts like the Clarity Act are stalling and may not go through at all, in my opinion, is the current risk off phase a sign of structural weakness for the digital asset class, or is it merely a temporary consolidation driven by macro or broader macroeconomic forces? The data that we can look at in front of us indicates that it is a combination of both structural headwinds and macro pressures, making the highly complex environment to navigate. Structurally, there is no denying that the immediate retail demand is softer. We see that directly reflected in Coinbase's disappointed earnings and its subsequent 11% stock crash. Additionally, the massive $8.22 billion loss by Strategy Inc. highlights the extreme balance sheet risks that corporations face when they hold large amounts of volatile digital assets during a market downturn. When the primary legislative catalyst, the Clarity Act, stalls ahead of the August Senate recess, it removes any type of structural hype that speculative traders rely on. Again, speculative traders rely on that hype to push and move markets and take profits from the volatility inside of that marketplace. However, the sell-off is also being heavily magnified by external macroeconomic forces. The fact that traditional stocks are also on the defense due to volatility in the crowded AI trades proves that this is a broad market-wide retreat from risk. When long-term interest rates spike post-Fed, it reshapes the cost of capital, making high-risk assets far less attractive compared to yielding cash or treasury instruments. This isn't just a crypto-specific crash, it is a global macroeconomic repricing of risk, and if we continue this way, one of the reasons why I think that in the end of 2027, going into 2028, is when we'll start to see our economy slow down with the possibility of a recession. Now, as we continue into the future, or as you decide to read over the news, the immediate outlook remains a little bit defensive. Next week is the final deadline for Congress as they leave for August recess, meaning that the window for the Clarity Act to make a surprise move is rapidly closing. Between high interest rates, muted retail trading, and a nervous stock market, speculative assets are going to have to fight hard to find their footing. Before we go to break, I want to talk a little bit about the Clarity Bill. Just a few months ago, in the first half of May, cryptocurrency investors were riding high. Bitcoin surged to a 6-month peak, about 80 grand, fueled in large part by massive wave of optimism when the Senate Banking Committee voted to advance the Clarity Act. This was supposed to be the Holy Grail. It's supposed to be a savior, a bill that's establishing a clear federal regulatory framework for digital assets that the crypto industry has been actively looking for. But Bitcoin is struggling around the 64,000 mark. And as we talked about in the New Wealth Transfer podcast, depending on how it plays out, it could even go lower, which is what I'm hoping for because we can buy even more. But the first major roadblock standing in the way of the Clarity Act is a fierce political ethics battle centered around dickhead Donald Trump. Recent financial disclosures revealed that Trump earned an unprecedented $1.4 billion from crypto ventures in 2025. For context, U.S. presidents have historically been exempt from conflict of interest laws that ban federal officials from participating in government matters where they hold a financial stake. Now, that doesn't mean that there weren't bad actors in the past that went around that rule. I feel that Trump is just more blatantly ignoring it and not trying to hide it. And so to limit ethic concerns, previous presidents relied on blind trust, divestments, or broad mutual funds. But Trump's massive $1.4 billion windfall has sparked intense fury among the Democrats. Senator Elizabeth Warren of Massachusetts publicly warned that the Clarity Act's current text does nothing to prevent him from vacuuming up his next $1.4 billion in crypto profits, which again is Elizabeth Warren going after dickhead Donald Trump, which I think that he should, but it hurts retail investors. That's the reason what frustrates me about Elizabeth Warren, about Nancy Pelosi, about those are the two that come to mind, about Donald Trump also, is that they only are thinking about the way in which they can get what they want. And I get where she's coming from, where it's stopping him from getting billions of profits. But by doing so, you're also hurting the rest of the people from possibly getting lots of profits as well. Warren and other Democrats argue that even if ethics limits were strengthened, the president could simply bypass enforcement by handpicking the very DOJ officials charged with enforcing the law. A group of 7 other Democratic senators, including Mark Warner and Ruben Gallego, issued a joint statement demanding that the bill's rules on ethics, consumer protection, conflict of interest, and market integrity be significantly strengthened. And I do think that that probably needs to happen. But again, the situation in totality is, are they doing that because that's something that they believe in, or are they doing that because they want to push it back past the midterms and push it into when maybe they're controlling both the Senate and the House so that they could affect it differently? And or is it just because they hate dickhead Donald Trump as well and they want to make sure that he doesn't benefit from himself being the president? Republican Senator Cynthia Loomis of Wyoming, a top supporter of the bill, has strongly defended the legislation. Her office argues that Trump has voluntarily agreed to self-imposed substantive ethic limits that are completely unprecedented in American history, noting that the bill explicitly bans all federal officials, including the president, from issuing or sponsoring digital assets. But despite these defenses, this massive ethical division has left the bill lacking the crucial Democratic votes it needs to survive. Even if lawmakers could somehow resolve the presidential ethic debate, the Clarity Act faces a second equally formidable opponent, the traditional banking lobby. The friction centers on a controversial provision in the bill that allows cryptocurrency companies to offer interest-like payments to holders of stablecoin, which are digital assets pegged directly to the US dollar. Traditional banks view that provision as an existential threat. A joint statement from multiple major bank lobbying groups warned that allowing crypto firms to pay interest on stablecoins would siphon away traditional bank deposits. And while I don't want Coinbase to have that, and I don't want the banks to have it, I feel that the banks are then controlling also the hurting of the people in general. And again, this just seems like a bunch of greedy people being greedy to make sure that they get theirs, while Main Street and the retail investors continue to get hurt while everybody else continues to line their fucking pockets. And the bank's argument is highly compelling to lawmakers of both parties. They warn that draining deposits from local banks will directly cripple the capital available available for local lending, the very loans that fuel small businesses, home mortgages, and family farms across American communities. But the point of the digital asset is that you are creating a new way and a new creator of those types of instruments, which Coinbase would be able to do, where you could actually lend against your assets and not having to go to a bank. With both Democratic and Republican senators expressing strong sympathy for bank concerns, the stablecoin provision has become a massive bipartisan sticking point. The double-barreled opposition brings us to a harsh logistical reality that the Senate's ticking clock is ticking away. The Senate is scheduled to begin a 5-week summer recess on August 7th, which is in a couple of days, 6 days to be exact, and they don't come back till September 14th. Jarrett Seiberg of TD Cohen's Washington Research Group notes that the bill's absolute best chance of becoming law was to secure Democratic support and pass before the recess. However, he currently gives the scenario a massive 1 in 3 chance of happening. What happens if they fail to pass before August 7th? While crypto advocates like Solana Policy Institute President Kristen Smith insist they are closer to ever to the finish line, analysts are incredibly bearish on an autumn comeback. Once senators return in September, they will completely consumed to try to avoid a government shutdown and fighting to win their upcoming midterm elections. Consequently, TD Cohen warns that if the bill gets pushed to the fall, its chances of passing collapse to below 20%. Capital Alpha partner analyst Ian Katz agrees, stating they will slightly slash the odds of passage down to 25 to 30% if the Senate recess is without a vote. Right now, bettors on the prediction market, Polymarket, give the Clarity Act just a 27% chance of becoming law this year. So it's probably likely that we are going to miss out on the Clarity Act this year, which hopefully will drive the prices of crypto lower, and that is a good buying opportunity. If the crypto lobby is more powerful than ever, why is a bill that has easily passed the House of Representatives last year suddenly choking in the Senate? The reality of the situation is that the Clarity Act is caught in a perfect storm of political polarization and economic self-preservation. When the bill easily sailed through the Republican-run House last year, it did not have to contend with the explosive political volatility of Donald Trump's personal crypto disclosures. The revelation of his $1.4 billion in crypto earnings turned a technical regulatory bill into a highly charged partisan battle over executive ethics. Simultaneously, the stablecoin interest provision turned this from a crypto versus SEC debate into a crypto versus mainstream banks war. In Washington, few lobbies, and I won't call them mainstream banks, I would say Main Street's really in crypto, but that's my opinion. In Washington, few lobbies are more influential than community banks, warning that local small business and farm loans are at risk. By threatening local bank deposits, the crypto industry overreached. Until the industry compromises with local banks on stablecoin interests and addresses the unprecedented executive ethics concerns, federal regulation will remain dead in the water, leaving crypto assets stranded in regulatory limbo. We'll be right back.
Look what TJ Maxx dragged in.
The Devil Wears Prada 2 is now streaming on Disney Plus and Hulu.
We are digital, we are downloadable, we are streamable.
The fashion event of the year is certified fresh.
Pull yourself together, we have work to do.
Critics say it's smart and witty and the perfect sequel.
That's all.
Get runway ready for The Devil Wears Prada 2 on Disney Plus and Hulu. Rated PG-13.
The hustle doesn't stop in NBA 2K27. Every game is an opportunity to master your skills. You can't guard me! To put defenders on skates with your bag of crossovers. And show off your limitless range. Chase greatness around the clock in NBA 2K27. Ball over everything.
To close out today's markets radar, I want to go down to South America and talk about Brazil. Right now, a high-stakes diplomatic standoff is unfolding. Brazilian President Luiz Inácio Lula da Silva is actively pushing back against what his administration describes as a coordinated effort by the Trump administration, dickhead Donald Trump, and a rising alliance of right-wing Latin American leaders to influence Brazil's upcoming October presidential election. The diplomatic friction reached a boiling point when Brazil officially recalled its ambassador to Argentina. This drastic move was in direct protest of Argentina President Javier Milei visiting São Paulo to endorse Flavio Bolsonaro, the son of jailed former President Jair Bolsonaro and the leading candidate for the Brazilian right. During his visit, Milei openly attacked Brazilian institutions, called President Lula a corrupt thief, and publicly insulted a Brazilian Supreme Court judge. For global market investors, this isn't just a political theater. It represents a fundamental fracturing of trade and diplomatic stability in the region. President Lula recently highlighted that under ideological constraints from the U.S. administration, Brazilian exports to the United States have plunged to a near 30-year low. In response, Brazil has aggressively pivoted its economy, causing commerce with China, which is now Brazil's single largest trading partner, to surge. With Trump having already imposed some of the highest tariffs of his second term on Brazil, which is a force of moving right-wingism or people on the right into more of power, is directly influencing an election and economy in a country that is not the United States of America. And while I'm not saying that countries shouldn't do this for the betterment of their people, I'm being cautious with that. I do believe that we have to wake up to the realization that the United States is stained with doing shitty shit to get their way as well. And the U.S. would not like it if Brazil was doing that to us. They wouldn't like it if China was doing it to us. But it's hypocritical because we also do the same thing to other countries to get our specific way. If Brazil's trade with the U.S. is hitting historic lows, while its relationship with China surges, how should global investor price the risk of an October election that foreign powers are actively trying to influence? Investors must prepare for a significant volatile premium in South America assets as we come into October. We are witnessing what experts call a complete breakdown of the long-standing diplomatic tradition of non-interference in Latin America. The political instability is severe. The Brazilian government even recently denied visas to U.S. State Department officials over concerns of a coordinated campaign to undermine confidence in the country's electoral voting system. If the right-wing opposition under Flavio Bolsonaro wins, we could see a drastic realignment of Brazil's trade policies back toward U.S. and away from China. Conversely, if Lula maintains his narrow 5-point lead and wins, the friction with both the U.S. and Argentina will likely intensify, further accelerating Brazil's economic integration with Beijing. With traditional shock absorbers eroding and regional leaders openly trading insults, Brazil has efficiently become a high-risk geopolitical battleground that will dictate supply chains and commodity markets for years to come. And this is another reason why I believe that China is doing a much better job of strengthening its partnerships and alliances in the event or when they decide to attack Taiwan and we get into a continued or larger scale global conflict. And with that, thank you for listening to Market Trader. Follow me everywhere at the age of Jeremy. And as I always say, be thankful, grateful, and kind, and we'll talk with you soon. Bye.